What's up, everyone? Welcome back to the Easily Profit YouTube channel. Now, in today's video, we're going to go over the 5 rules that I always use in day trading to actually consistently make money. So this thing is, I want to break everything down where it's very simple to understand. You can utilize these rules for your trading. And even though it may not make more money per trade, it's going to stop a lot of dumb losses that actually stop you from being profitable. So let's just jump right into everything. No BS, always bangers on these videos. Let's jump right into it. 5th rule that I like. Yeah, I don't want to break. I say this all the time. You'll see videos from 2016. I kept on saying this. Don't trade within the first 5 minutes. There's a lot of things that go into this. It's a very simple rule, but a lot of things psychologically work into this. Number 1 is going to be that trends and market conditions that you see in the pre-market aren't always going to carry over into the intraday. If you look at one of the most prime examples, if you look at MRIN, you can see that the volume on average, especially if you just look at the volume average in the pre-market, may seem normal. But once we get into the intraday where everybody is trading, everybody is taking action, the volume can get completely different, very, very high, very, very volatile. So essentially, any type of trends you see or any type of moves you may see taking place in the pre-market doesn't always perfectly translate into the intraday. And off of that, what I like to do is, since I like to wait the first 5 minutes out, you get to develop a directional bias. So directional bias, what I always say is give 5 minutes to play out, then you can really see the true nature. A lot of weak hands and individuals that are willing to take profit at a moment's notice on any type of upwards move usually look to dump their shares within the first 5 minutes. So if we look at the average of price from the opening price of the first minute to the close price of the 5th minute, even though you have this very, very nice spike that develops and is going to entice a lot of people to jump in, after 5 minutes, you actually have an overall negative price trend. So this little tip this quickly can save you from potentially taking trades on this upswing, getting caught into this trade, and let's say you may be in profit for a very short period of time, but it can quickly turn against you and be very, very dangerous to the downside. Very, very quick tip. Should work like wonders. Rule number 4, never use a market order on an upswing in price. So whenever prices upswing to the upsides, for example, you see these green candles start to move up very, very quickly, a lot of the sell side or the ask side of the level 2 likes to take advantage of upswings, and people are going to move their sell orders to higher prices. If you use a market order to buy, a market order buy is automatically going to default to the near seller's price. So as those sellers are constantly incrementally moving their prices up, a lot of times you're going to end up top ticking or entering at the utmost side of that candlestick, and then now you're going to need a perfect transition and a perfect follow through, or if that doesn't happen, you're going to instantly be in a loss. One of my things is, psychologically, what I do is I actually train my brain to look at small red candles and small red pullbacks as proper entry points. It seems counterintuitive, but the strong green candle, once you spot it, it looks good, but that's usually the worst opportunity. Small little red candles that pull back near the moving averages or near indicators are actually going to be more viable opportunities, because now a lot of those weak hands have been shaken out of a position, and then it's going to be much easier for your limit order to execute because you're not going to be chasing that position on the upside. You have to break this down. Watch this over and over. It's going to start to slowly make sense. So when we think about spread is going to be the difference between the bid and the ask. The nearest buyer's price, that can be somebody looking to buy shares or a short seller looking to cover, versus the nearest ask price or the nearest seller. Somebody looking to sell shares they previously bought or a short seller looking to jump their position. It's all the same. But at the end of the day, the difference between the prices is going to add a different dynamic into the trade. So spread being that difference, the larger the spread, the less people that are going to be in between those prices. So if I want to buy this trade, I have to buy from a seller. I have to sell to a buyer. So if I want to buy right now with the market order, I'm going to enter at 336. If I need to sell this trade in a moment's notice, I'm going to end up selling at 320. So I'm going to lose 16 cents off rip that quickly. Now, this is usually a byproduct. If you're looking at the spreads, how they're widening up, this is a byproduct of volume. The more volume a company typically has, you can see this only having 600,000 volume as we're into the middle of the day. This is usually going to be a byproduct where you're going to have very, very large spreads. The larger volume companies, let's say, for example, DARE, 196 to 197, 1 penny per share spread. Very, very, very tight. And that's going to be a byproduct of having high volume. Now, the reason you don't want to trade these larger spreads is just there's more room for things to go wrong whenever you're using orders. Or, for example, a lot of times the charts are going to look much choppier. So if we look at this company here and we move this to the charts, obviously this is a warrant company, so I'm not going to trade it just based off that alone. But you can see that a lot of the candlesticks and the developments of this company is just going to be much more choppier by this time of the day. And then it's just not a very, very clear trading process. If you go to Dare, then obviously you're going to see much more of a clear pathway of how this company is moving. Tighter spreads is going to equal a cleaner chart, and you're going to have more precise entries and exits. So only trade within a 1% margin. So if a company is $10 per share, only use 10 cents worth of margin. Anything more than that, off limits. If it's $1.30, use 1 to 2 pennies at most. Other than that, it's not really worth it changing. That's how you get to become very precise in what you develop on a watch list. So rule number 2, this is a rule that I always talk about. You can see older videos, I have this talking about this as well, is trade the windows. So the windows are going to be areas or like times of the day where there's more activity. So think about it. The more activity that's going on, higher volume, lower spreads equals a better trading environment. And also where there is more people, a lot of times there's going to be more inexperienced people that cause prices to run up to ungodly amounts. So a lot of those huge bull runs and huge dumps and crashes that you can profit from whenever you're short selling, or large runs that you can profit from whenever you're going long, a lot of these happen in very localized areas. So the obvious one is, and there's going to be 3 windows, the obvious one is going to be the first hour of the day. The first hour of the day, typically you're going to see the majority of the most amount of volume. Most people aren't going to be full-time day traders. So what do? They have a job. So usually before work, or usually they will block out a little part of their schedule so they can trade the open or trade within the first hour of the day. A lot of people can do that. Now, most full-time traders, truthfully, even me, I'm not sitting at my computer from 8:30 all the way to 3. I'm usually taking breaks in between, running errands and things like that. So within the first hour, I will take my time and look at positions, and a lot of my activity will localize in this area. The second window is midday. Usually midday for me, I usually call it right around 12 to 1. So between 12 to 1, you're going to have sometimes another perk up in volume. You can see here it happened a little bit earlier, so there's a little bit of a window between midday. Midday is a little bit more, it's not really solidified as a perfect time frame, but usually once I get past the first hour, I'll take between a 30-minute and an hour break, and then I'll come back to see whatever is developing usually during that period. And the third window is going to be power hour, or the last hour of the day. So the last hour is going to be rampant with a lot of people looking to take positions on trades to potentially swing into the next day, or looking to close out positions before it reaches the weekend. On, like, especially what you're going to see is on Fridays. On Fridays, you're going to see a lot of people dumping shares indiscriminately before the end of the market. And the main reason for that is you have a 2-day weekend. Those 2 days, news can come out that you can't react to. So imagine over Saturdays and Sundays, CEOs are doing their thing. They're talking to people, doing things like that, making deals happen. And then once Monday comes along, boom, that news report is going to drop. So a lot of people don't like that limbo status, so they will dump shares before Friday and re-enter. And there's other things that happens with options and spreads and things like that. There's a more complicated answer to that. I mean, for the sake of time, might as well. Don't average down. Don't double down on a losing position. Now, I only like to trade in blocks. I like to trade solid position, 1,000 shares, 1,500, 2,000, 10,000, whatever I'm buying initially. And then either I'm selling that full amount, or if we are in a very rapid upswing in prices, just running and running, I will incrementally take profit on the upswing. The problem with averaging down is you're trying to turn bad analysis or a bad trade into still a profitable position. You're trying to force too many things. So for example, let's say you broke your rules, or the rules that I said here, and you just buy out of the gate and it just starts to dump. At a certain point, you may think, okay, I should double down. I should buy the same amount of shares I bought previously, so my average is pushed down. So if you double down here, you buy another 1,000 shares at this point, your break-even level is going to be at this point. Now, the problem is with a lot of human psychology and human nature, even if we have the perfect scenario where, if let's say you made this mistake, you bought 1,000 shares here, you doubled down and bought 1,000 shares here, and this is your break-even point. A lot of times when it gets to your break-even point and now your P&Ls are zeroed out, I can guarantee you're not going to just cut it from that point. You're going to look to potentially have it come back up to your initial entry point, and you can possibly make profit, because now this is your average, and now you're making profit above your average entry price. a lot of times that's the way, even though you may not think like that, subconsciously that's what you're going to be doing, and then you're going to push a trade too far, and then now you're going to end up being double down in a position that's going to go even further to the negative side. So it's one of those things that this is why stop losses are a must. A stop loss should be the 6th rule that I have here. Always use stop losses and base your stop losses off of any type of defined points, either being like the VWAP. I use stop losses at VWAP. I use stop losses at the opening price. I use stop losses at psychological levels like whole numbers. So all that said, the problem with doubling down is, even though you can make back that loss in those very short-term increments, the majority of the time, making back that loss isn't enough. You're going to try to turn it into a profitable opportunity, and it normally doesn't work out. And then now you're going to be double sized into a position that's going to keep on losing, and you're going to lose even more than by you just taking your stop loss. So hope these rules really help. These are the ones you need to implement. So even though you may have a strategy that is different from mine, if you want to see some of my strategies, look at my older videos. I have that 6-figure strategy. I have the swing trading strategy. You've seen some of the stuff is already working. I show my P&Ls and things here and there. If you need information, just let me know, just message me. So I hope you guys enjoyed today's video. Now, just for me to reiterate, number 1, don't trade within the first 5 minutes. Number 2, no market orders on the upswings of price. Number 3, only trade within a 1% margin of spread. Don't have those blown out spreads and trade those stocks. Are crappy, horrible companies. Number 4, trade the windows, first hour, midday, the last hour. Those little windows always have the most amount of volume. And number 5, don't average down. Don't turn a loser into a bigger loser. If you guys need any more help, you always know where to find me. Hit up the website. I'm always here. I'm always available to your disposal. So let's jump into it. Let's make some money this summer, guys. Let's do it.